Hey, welcome back to Wall Street Silver. We have the legendary, the amazing, the one, the only, the man who needs no introduction, Rafi Farber. Thanks for joining us, dude.
Hey Jim, good to be here.
Hey, first thing I got to ask you, what's going on with Comex with your 5,000 ounce contract?
All right, so I've put in like something like 10 intents to receive on the contract, and an intent to receive is not it's not standing for delivery. It's just telling the system that at the rollover deadline, don't push me out. I'm standing for delivery on this contract when the date comes for first notice, and I want to pay for it. So the idea it has to be fully funded, and they don't really know what the number is, what fully funding means, to the dollar. So I asked them, how much cash exactly do I need? I mean, I have a fixed price that I bought the contract at. That doesn't change. So the contract is an agreement to buy 5,000 ounces at the price that I bought the contract, plus the margin that's needed. So I already have way more cash than the contract is valued at, plus the required margin maintenance. So, but every time I file to receive, I get a notice like a few hours later that I'm short. Last time it was 300, and now I'm short another 1,500. I don't remember the exact number. The system keeps telling me.
So you put an extra 10K just to get way above or something?
Yeah. So like I decided to kilo, how you say it in English, to sort of like nuke the system and really, but get the cash way above anything that they could say that it's not enough. Which I thought I already did. But if this doesn't work and they tell me again that I don't have enough cash, then there's really nothing I can do other than switch brokers.
Is it Interactive Brokers or is this a scam? I mean, you seem to be going two different ways with this.
No, this is it. The scam, I'm not saying that nobody's stealing any money from me.
Yeah.
It's all in the account. I didn't
lose
roadblocks.
Anything. They're created artificial roadblocks that don't need to exist.
I mean, and again, I'm not by scam. I guess colloquially, I'm saying that they advertise that they help their clients stand for delivery on physical delivery contracts. So I mean, I straight up asked the guy who I was on the phone with, "Have you ever done this before?" He's like, "No, you're the first guy for Interactive Brokers." So I'm like, I guess you don't really know what you're doing, and they're trying. So really, they don't know what the system is saying anyway. They don't know what the calculation is for exactly how much cash I need. But I put in, a ton, and it really should work. When this clears, the cash to settle, it'll settle on Wednesday, and then I'll file the intent to receive again. And if not, I got an offer from someone who's connected to some brokerage, RJO or something. I don't remember what the name is. Somebody tweeted me and said, if you have problems with IBKR, switch, move the money over to this brokerage, and we'll help you out. So it's not going to end here. I'm going to keep trying.
All right. So the saga continues. Thanks for the update. The other thing I wanted to talk about with you is something else that you seem to be up in arms about. And let me share and I'm right there with you on this one. Inflation was hot in July, but rent isn't showing up yet and could drive prices even higher. What's got you going on this one, Rafi?
Yeah. Well, this article, I think it was the first semi-honest investigative financial journalism reporting out of CNBC that I've seen in my financial career. I mean, I wouldn't call it exactly honest reporting, but it came close because there were a lot of quotes in this article that were, and if you scroll down, you can see them. Economists basically saying these rent numbers in the CPI are BS, basically, and they're not true. So, and they're putting these doubtful quotes on the BLS rent data at the front of the article, which means they're trying to emphasize it. And usually they bury the stuff they don't want you to read at the end. So yeah, the first quote says the composition was mixed, but generally softer than expected as housing inflation slowed. And then it says, the quote says, in stark contrast to the surging rents in the industry data. So that's sort of like a diplomatic way of saying,
CPI fake.
This is all a bunch of bullshit.
All a bunch of bullshit. They're just making it up. Yeah. Wrote Goldman Sachs chief economist Jan Hatzius. Okay.
Yes. And there are more quotes like that, but down in the article that say basically like the industry data. You can stop there. So there's one from Bookvar, right? It says the rent component is dramatically understated relative to reality. Again, a nice diplomatic way of saying this is a bunch of bull.
Yeah.
And rental increases, which is the biggest chunk, is only going to accelerate here. It's the biggest chunk of the CPI. Right? I was telling Lee off camera that what's been pushing the CPI, which I see only as important in terms of the psychological effect it has on the public. I think the numbers are a bunch of lies, but the number that is published is the number that they can get away with. And the used car prices that have been pushing up the CPI lately are only weighted about 7%. But rent,
what's housing and rent? What's that in the weighting?
Housing and rent is weighted 33%. It's about a third of the entire CPI. So first of all, with used car prices, we saw them go up another 0.2% month over month after these humongous double-digit month-to-month increases. So used car prices are not getting cheaper. They're not falling.
Yeah.
They're rising slower. But the year-over-year numbers that are affecting year-over-year numbers of the CPI are going to stay elevated in the 40% range, or the whatever, 30 to 50, I don't know, some huge number, until at least April of 2022, because that's when those numbers started to skyrocket. So the year-over-year numbers are not going to get depressed until about 8 months from now. So that's going to maintain the CPI numbers high from that angle. And then you have rents that these mainstream CNBC quoted economists are saying are a bunch of lies. So eventually, I'd say maybe the next report, maybe the one after that, the rent numbers, which are weighted 33%, about 3 times the weight of the used car prices, are going to start to really move up, and you're going to see the CPI head even higher than 5.4% year over year. And these numbers are going to start scaring the bond market psychologically. So we're looking for a psychological flip. That's the importance of the CPI.
So as these eviction moratoriums end in the United States, what do you project? I'm sorry, what do you project is going to happen there? Are people just going to walk away from it, or people have to come up with the money, or how does that play into CPI?
Yeah, I mean, the thing is, I don't even know how the BLS is calculating. Do they calculate if someone's squatting in a eviction moratorium, he's not paying any rent? Does that count as zero, or is it the amount on his contract? Or what are they even doing?
I'm sure it's hedonically adjusted to reflect lower inflation, right?
Well, yeah. I guess that if everyone's paying zero rent and that's 33%, and that was, are they just asking the landlords, what would you charge if someone were actually paying? Is that how the number they use, or is it
they have
some other fiction? I guess there's a huge wiggle room right there with what's going on. I'd love to know that answer is.
It'll be interesting, Jim. If people walk away, they still need to find a place to live.
Yeah, but if you get a new place before your credit's trashed from you not paying,
were they going to live on the street?
No, you go rent a new place that's now available, but you do it before you get, your credit gets trashed from not paying on the one that you're walking away from, right? And then
I'm assuming a lot of people are going to be downsizing in terms of space. So I would imagine the lower end of the market for rentals is going to see a big increase in demand, and maybe like the middle and upper habitational market is going to be toast. Would you agree with that, or do you have another take on that?
Yeah, I would agree with that. But I think primarily what's important is that these squatters are going to be out. They're not going to renegotiate contracts because these landlords already know that they're squatters, and anytime they get any excuse not to pay, they're not going to pay, and they don't want the problems anymore. So they're going to get them out as soon as they can, if they can even survive this. These landlords are getting destroyed. And this is injustice to the nth degree that I don't even want to fathom being in these people's shoes. Either the squatters or the landlords, they're both getting screwed.
Yeah, the squatters are. I don't know. I doubt they care. They got free rent.
Yeah, they don't care now, but they're going to care when they're on the street or wherever they're going.
Yeah.
Yeah,
but you're right. What I see happening, a lot of landlords are just, middle income people who have a couple of apartments or condos or townhomes or whatever, and they're getting screwed here, and they're going to get foreclosed on eventually once these, foreclosure moratoriums end. And guess who's going to be stepping up to buy? It's going to be BlackRock, who has capital.
BlackRock. I was going to say that. BlackRock's going to own the whole country.
Yeah, at a quarter. Well, BlackRock's cost of capital is what? Just 10 basis points over the 0.25% or something like that. 0.35 or whatever they can get capital for. Yeah, if you got free money, that's effectively free, you can afford to buy everything and then rent it out. And make your money on the spread. But how much of that is actually going on? I don't know. But how much can you trust of what you read, anyways?
Can we break this out a little bit into a macro discussion on the Fed and what they're doing? You look at the money supply, and it has just been growing and growing and growing. I'm going to throw up a chart here. Okay, this is the M1. Okay, and then this is the money velocity, which has just been crashing. So the Fed looks like they're pumping money into the system, but it's just not getting out. I had read recently that the loan to deposit ratio in most of the banks is just crazy high. They're just not lending; they just have huge deposits. So I mean, to me, this looks like the Fed is just pushing on a string. They're flooding the market with liquidity. It's not being moved out. It just seems to be just flowing into the capital markets. And when it does shift and go out, I would imagine inflation is going to explode. What's your take on all that data?
Well, the M1 chart you showed, it is going vertical, but not as vertical as that chart shows, because that huge line up, and there was a huge line up, but somewhere in that data, I think around February, the Fed combined M1 and M2 and just called it M1. So there's a little bit of artificial bump in there. Okay. But yeah, but you see after that huge vertical line, it's the money supply is sort of going in a diagonal up much faster than it ever did. And that is still true. The question is, where's all this money going? And the answer is simple. It's going into reverse repos right back to the Fed every night. I think today we passed $1 trillion again in reverse repos, which means all this extra cash that the banks have, we're just pushing it right back to the Fed in exchange for treasuries. And it's being like ping pong back and forth between the Fed and the banks every night. And every night the banks earn another 0.05% on it. So, at some point, this is not going to be like a gradual unwind. It's not going to be like, oh, the money's going to slowly go into the system. And everything will work itself out over a few months or years. No, I don't see that happening at all. There's going to be some kind of violent event, and nobody knows what it is because, look, frankly, we're in a part of financial history that nobody has experienced before in all of humanity. I mean, we've seen it in isolated countries where they print money like this and these kinds of things happen, but this is global, man. I mean, this is something that none of us have ever seen. And to think that the Keynesian econometricians at the Fed understand what the hell they're doing is dangerous naivete. They don't understand it. And we don't understand what's going on, and they don't understand what's going on. We just see these gigantic, enormous numbers and these weird financial constructs with these crazy names like reverse repo that make no logical sense because they're only constructs that exist because monetary policy is so crazy. So something is going to break somewhere in some short-term lending market, and all of this money is just going to come flooding out of somewhere at once into something else, and then you're going to see some kind of breaks. And I can't really tell you what it is. It's just going to be violent, and gold and silver are going to be involved.
How much of this ridiculous increase comes from that cost pushing inflation as opposed to just money creation?
I don't think that we can really differentiate or call cost push inflation really a factor, because I'll try to explain that. Like, for example, in shipping, like you can point to any specific problem and say a port got shut down, or ships are hanging out at ports because of lockdowns in the past. Now they got to clear up the line. But the fact is, all those factors in terms of supply side or cost push, they all come down to the money supply. Because if the Fed hadn't printed the extra money, there would be less people or less demand pushing for these goods to ship them, and the supply and demand would even out, and there'd be less ships in a line. The reason that there's so many ships on a line waiting to unload their cargo is because people have so many dollars, and these dollars are chasing the prices in a curve from what they were before, and that's what's causing the backup. It all comes back to the monetary inflation in the first place. So
that is a very point, Austrian argument that you just made.
Oh yeah, right? I'm an Austrian school economist. So yeah, that's where it goes.
It's reality in my worldview.
Yeah.
Well,
so hey, yeah, I mean,
I want to share something about that. You were just talking shipping costs. Let me share something I have up here. It now is costing $32,000 to move a 40-foot container from China to the west coast of Florida. And I used to do this. I used to import equipment from China, and it cost me $5,000 back a couple of years ago, or $4,000 even. I think it was $5,000 or $6,000 once all customs and all were included and some handling fees. But the raw cost to move this is 8 times more expensive to move a 40-foot container than it used to be for me. We are so dependent upon Asian shipping to get so many products to the United States. If this continues, it's got to trickle into pricing somewhere.
Yeah, and there's another factor in shipping prices, right? Mm-hmm. That pushes up prices even faster. I mean, I've heard the argument that if shipping is so expensive, then that encourages domestic production, et cetera, and prices should come down. But that takes time. That's long-term stuff, and we don't have time. Yeah, we don't have time to go that far now. We're in we're in the final innings here. But what happens in the short term when you have shipping that expensive is not even necessarily that people can't afford it, but you just can't get the good. You can't get the inventory. You can't get what you need to sell to your customers in the domestic market. So you have to conserve your inventory. And how do you conserve inventory? You've got to raise prices to conserve your inventory, so that it leads to incredible price rises, not even necessarily from the shipping itself, but from the fact that you can't get anything.
Yeah. Well, you've got to have enough capital to replace your inventory. And if you're selling all your current inventory at below your replacement cost, then you're pretty much screwed. So people ask that question with gasoline as to why are they raising the prices right now? Oil just increased. That gasoline, at the gas station, they didn't buy it at a higher price. It's like they got to replace their inventory. If they don't charge enough now, that's why the gasoline at the pump prices always rise faster than they come down when oil falls. I mean, it's just something a lot of people don't really intuitively understand, but I get why it happens. But
so Rafi, to boil down what you're saying here, I think what you're saying is that there's all these things that are just kind of coming together, and at some point they're just going to shift mass psychology, and prices are just going to explode. Is that
yes
a summary?
Yes, that is exactly what I'm saying. At some point, there's going to be a pivot. There's going to be a change. Okay, and the last time it happened, if you look at a chart of the 1970s, it happened in January 1977. That's when we often forget, and this is a very important point, that the tightest monetary policy from the Fed in all of its history was from 1977 to 1980, the tightest. And that was under G. William Miller and his successor, Paul Volcker. The Fed funds rate kept rocketing up in those 3 years. But while that was happening, that was precisely when silver met its its $50 top, and gold at 872, whatever crazy number it was. It was during the tightest monetary policy in history. Why? Because psychology changed. Because everyone knew that the Fed was chasing inflation, was trying to get out in front of it. Mm-hmm. But there's a big difference now between now and the 1970s. In 1970s, it was a theoretical possibility, and it turned out it was a real possibility because it actually happened. It was possible for the Fed to get out in front of inflation, because as painful as 20% interest rates were, it was still possible to do it without, starving masses of millions of people. But now, forget it. That's impossible.
Yeah.
So when the Fed has to start chasing inflation, everyone's going to know they just can't do it. And that's when you have like a sudden psychological realization that this battle is over before it even started.
Well, our people might be asking you, and I already know the answer, but I'm going to throw out the softball for you. Why? Okay, in the 1970s, we had debt to GDP at 35% debt to GDP. We didn't have so much debt. Why can we not now go to 20? Why can't the Fed raise interest rates to 20% this time?
Yeah, well, I mean, forget about the debt. I mean, just think about how massive the bond market is and how many banks and institutions and foreign central banks and all these future dollar holders, future dollars meaning treasuries holders, they have them stuffed in their vaults all over the world and all over these banks. And then what do you think happens to the prices of these bonds that are stuffed everywhere all over the world? What happens to them when interest rates rise to 5-6%? They collapse through the floor, and all these bank balance sheets go kaput all at the same time. So I mean, it's the global banking system that won't survive this. Forget about the interest on the national debt. That's nothing.
Well, and you got to think about all the derivatives that are linked to all the bonds and the securities that are packaged together, and there's so much leverage piled on top of every bond. It's not just the bond itself, it's the leverage piled onto it with all the derivatives, correct?
Yes. Everyone is piled onto everyone else in this kind of grotesque sort of mountain of financial garbage. Mm-hmm. that's what's happening.
The Homer Simpson analogy. Got it. The garbage.
Yeah. So that's the danger of people trying to trade in and out of this stuff. One day, everyone's gonna realize what's gonna happen, and like this is not like the 1920s in Germany where people have to take physical cash and give it to a broker and try to get out of it or something. Mm-hmm. This is the age of social media where news of anything travels instantly everywhere instantaneously. So how long do you think it's going to take once psychology changes for everything to just flip? Yeah. It could be very fast, and you can't be out during that time. You've got to be in before it because you're not going to catch it.
Let me ask you a question. We've been talking a lot about prepping lately. And as you're saying this, my mind just races. And I'm like, oh my God, at one day, you're going to go to the supermarket and you're not going to be able to get anything because everyone's going to think like the prices are just going to explode.
Yeah.
Happening?
Yeah.
Yeah, I do see that happening.
That's why the Alaskan preppers, like, have your 90 to 180, 3 to 6 months of food that is not going to go bad, stuffed somewhere in your house, in the closet somewhere. So you're not rushing. You don't want to be the guy rushing to the grocery store on that day.
Yeah, but I mean, we can add a good note to this, a calming note, okay, especially for gold and silver bugs, right? It's not like the day after this happens, it's not like all the crops die and all the farms just burn up and all the food goes away. Nothing physical changes here. It's just the medium of exchange goes bad. Mm-hmm. So everyone caught with money substitutes instead of real money has no purchasing power. So where does the purchasing power go? It goes to holders of real money. So yeah, you can vault your gold and silver somewhere with a private company, sure. You can have a few ETFs if you want to play the game and try to accumulate dollars using your gold and silver, sure, fine, play the game. But for when this thing falls, in order to buy food, people are going to need real money. Supermarkets are going to need real money from you in order to part with their food because they can't buy more food from the supplier without real money, and they're going to need it from you. So if you have silver, gold's not going to be that useful for like going to the supermarket with a gold coin. What are you going to do? Buy an entire aisle of food? You can't, forget it. You'll need a few silver coins, and this is why really half the battle is buying physical silver and storing it somewhere where you can get to immediately. To go to the store, to get food for your family, to get whatever you need. because people will use that stuff for actual money. They'll trade the coins. That's where it will go in the immediate aftermath of this stuff. I don't know what's going to happen to Bitcoin. I don't know what's going to happen to the whole blockchain thing. If the financial system collapses, what happens to the spreadsheet? I don't know. Maybe something good, maybe something bad, but I don't want to risk my life on knowing what's going to happen to Bitcoin. I want my silver.
Yeah. We'll see what happens. I mean, it's a very digital society. It'll be interesting to see whether large chain grocery stores will start taking anything other than dollars, or whatever the national currency in any country is for, as a transaction for your grocery cart full of items. We're in a new world. We're in a brand new world. I have no idea how this plays out. But,
the picture that Rafi's painting to me is like the ultimate Keynesian nightmare unfolding in front of us.
Yeah. Well, anyways, on that happy note, Rafi, thank you very much for providing us with an update on your Comex adventure and the latest inflation data, and such a pretty picture and such a happy thoughts. But that's what we love here on Economic Preppers, Wall Street Silver. Thank you very much, sir.
Thank you for having me.
Good to see you again, Rafi.